Imagine you have access to a supercomputer. You feed it every piece of financial history, every corporate earnings report, and every market fluctuation ever recorded, asking it to output one perfectly rational strategy to beat the stock market. This chart shows the resulting market returns. If every investor uses that exact same supercomputer, they all identify the exact same traits. Everyone buys at the same time, driving the price up instantly, and the returns flatten out entirely to the market average. The competitive advantage disappears the moment everyone shares it. If you're a civil engineer calculating the load on a bridge or a dentist filling a cavity, following the exact same precise steps as everyone else guarantees a successful outcome. The physical laws of concrete or tooth enamel don't change just because another professional is doing the same work. But investing is a competitive puzzle. The stock market prices assets based on what people think they are worth. When everyone has access to the exact same perfect information, they bid the prices up until all the potential profit is squeezed out. Universal access to data actively destroys your ability to outsmart the room. Decades ago, beating the market was a matter of physical endurance. An investor could find highly profitable opportunities simply by being willing to dig through paper records that others were too tired to read. In the 1960s, understanding a company's financials meant writing a letter for an annual report and waiting a month for it to arrive. Or you pulled a massive Moody's manual off the shelf, squinting at thousands of tiny, densely packed numbers printed on fragile onion skin pages. That sheer friction kept the majority of the market completely blind to certain financial realities. Today, that friction is gone. The exact same quantitative data is beamed instantly to millions of retail trading apps the millisecond it's published. Raw data parity is the new baseline. You can no longer win by finding hidden numbers. To generate wealth now, you have to look at the exact same numbers everyone else has and extract a completely different conclusion. The billionaire investor Howard Marks calls this framework second-level thinking. It is the mental model required to survive in an environment where information is equally distributed. This diagram shows how first-level thinking operates. It is straightforward and logical. An investor looks at a business, sees they make a great product, concludes it is an excellent company, and decides to buy the stock. But second-level thinking continues the diagram. The investor realizes that because everyone knows it's a great company, everyone has already bought the stock. That collective consensus has driven the price up so high that the stock is now overpriced. The mathematically correct move, despite the great product, is actually to sell. This goes beyond simply doing the opposite of the herd. Anyone can be a blind contrarian. Second-level thinking requires running a strict calculation to pinpoint exactly where the general consensus has mispriced the asset. Marx proved the value of this logic in the late 1970s and 1980s by applying it to high-yield corporate debt, widely known as junk bonds. At the time, major institutional investors and banks refused to touch them. First-level thinking dictated that these bonds were issued by struggling companies, making them inherently toxic and completely unsafe to hold. This chart illustrates Marx's analysis. The panicked market demanded interest rates that assumed a 5% probability these companies would default on their debt. But Marx and his team ran the underlying financials and calculated that the actual risk of default was only around 2%. Because the market was pricing the bonds for a 5% failure rate, the interest payouts were massive. By buying up the debt that everyone else was irrationally afraid of, Marx safely secured those high payouts, extracting huge excess returns for his clients. The most significant financial returns rarely come from taking wild, blind risks. They are generated by accurately pricing the spread between hard reality and the herd's irrational fear. The stock market functions less like a precise, objective calculator and more like a pendulum, swinging endlessly between extreme human optimism and deep human pessimism. These emotional swings are the true engine of the economy. They are what push a standard period of growth into a wild excess, and eventually into the extreme busts and crashes that quantitative models routinely fail to predict. Even with today's advanced data forecasting, sudden external shocks still trigger massive behavioral shifts that completely shatter established economic trendlines. This is exactly why artificial intelligence struggles to navigate these extremes. An AI model excels at predicting the future by strictly extrapolating past patterns. But the most severe economic cycles are driven by highly irrational, entirely unique human reactions. If you asked an algorithm to review 5 business plans and pick the one that represents the next massive leap in personal computing, it would search for similarities to past successes. It could never identify a true visionary, because true innovation requires recognizing a pattern that does not even exist yet. As long as people are involved, human psychology will continue to create sudden, irrational extremes that a purely mechanical algorithm cannot safely navigate or exploit. If your goal is to build exceptional wealth over the next 40 years, you have to entirely abandon the psychological comfort of being right alongside the rest of the crowd. Your task is to look at the exact same earnings reports and price charts available to everyone else, and specifically isolate the emotional bias, the fear or the greed, that the market has built into those numbers. The late Charlie Munger frequently highlighted the immense difficulty of adopting this exact mindset against a market filled with highly educated, highly motivated people. He noted that the concept of outsmarting the consensus is entirely straightforward. It is a simple set of rules to understand, but putting it into practice and holding your ground when the rest of the world thinks you are wrong is not an easy task. In a modern world overflowing with infinite data streams and predictive supercomputers, the ultimate remaining advantage is the psychological discipline to stand apart from the herd.